there. For those of you who don't know me, my name is Joe Gaudio. I am an owner of a local financial planning firm here in Vancouver, Washington, called Jag Financial. I do service clients throughout the United States, however. So today I want to talk to you about 4 year-end tax planning strategies that I implement with clients that might be helpful for you as well. Number one, make sure you're maxing out retirement plans through work. Whether it's a traditional 401k or traditional IRA, this is the time to make sure that you've hit those thresholds. If you have room left in your budget, to go ahead and have them do some larger withholdings these last few pay cycles that we have left in this tax year. Number two, consider doing a Roth IRA conversion, especially in a situation where your taxable income is lower than it has been in years past, and you expect it to be higher in the future. This is a great strategy that we use with clients and a very good tax-deferred and potentially tax-free vehicle for the future when it comes to retirement planning. Number three, take advantage of tax loss harvesting. So what this means is if you have a non-qualified account or a joint account or a trust account with a spouse, take a look at your investments prior to year end. And if you have any that have a substantial loss or losses in them, you can go ahead and sell those out right now and potentially take a loss to offset other gains or potentially as a loss on your taxable income for this tax year. Now, you do need to make sure you check with your accountant prior to that to make sure that you're within the limits that are allowed. Number four, and this is important and a strategy that isn't used very often, but I do use it in my practice with clients, is if you're 73 and older and you're charitably inclined, you might want to consider to start using your RMDs, which are your required minimum distributions on your IRAs and 401ks, and actually use those as a charitable deduction or contribution. Now, what that does for you is it allows you to donate the money to a charity of your choice, and then that donation is not taxable income to you for that tax year. The IRS does force you to take money out, but it doesn't force you to take it personally. So you could actually donate that to a charity of your choice, again, if you're so inclined. So those are the 4 topics that I wanted to go over today. Tax planning can be complicated. The rules regularly change, and there are multiple moving parts. So make sure you consult with your tax advisor before making any decisions that we discussed today. A few important disclosures that I need to get through as well. So the opinions that I've voiced today are really my opinions and the strategies that I use in my practice. They're not recommended for any individual, or this is not intended to be any individual recommendation. You need to seek appropriate financial help and professional help in order to make the decisions that are right for you and your family. Number 2, traditional IRA account owners should consider the tax ramifications, their age, their income restrictions, and other assets before they convert any traditional IRA to a Roth IRA. Tax loss harvesting that we discussed a second ago is another strategy discussed, and this is also another important topic that needs to be discussed with either a CPA or a financial professional before you make any big changes on your overall portfolio or allocations. This information is not intended to be suitable for a specific individual or individuals, and it's not tax advice. We suggest that you discuss your specific tax issues with a qualified tax advisor. All information is believed to be from a reliable source. However, LPL Financial makes no representation to its completeness or its accuracy. For additional information regarding these topics and others, please contact me at the office. Thank you for listening and have a great day.